Did you know there's a trading strategy called the engulfing candlestick that many traders find challenging to master? While it's a super profitable approach, some people hesitate to use it because it relies heavily on candlestick sizes. But here's the exciting part. When applied correctly, the engulfing candlestick strategy can yield remarkable results, boasting an 87% win rate. The engulfing candlestick pattern is a popular technical analysis tool used to predict trend reversals in the market. It consists of two candlesticks. Bullish engulfing pattern. When a green candle's body fully covers or engulf the body of the preceding red candle, this signals that the price may start moving upward, showing a shift toward bullish momentum. Bearish engulfing pattern. When a red candle completely engulfs the body of the previous green candle, this indicates bearish momentum, suggesting the price may move downward. The reason this pattern is so powerful is that it reflects a significant change in market sentiment. A bullish engulfing suggests buyers have overpowered sellers, while a bearish engulfing indicates sellers have taken control from buyers. While this pattern is reliable for spotting momentum shifts, it's not foolproof. To maximize its effectiveness, it must be used alongside other technical tools and within the correct market context. Why do traders struggle with this strategy? Many traders find it challenging to identify engulfing candlestick patterns in real time. Here's why. The size of candlesticks can vary greatly, making it difficult to judge whether one candle is truly engulfing the other. The pattern may appear frequently in the market, but not all instances lead to profitable trades. Beginners often fail to confirm signals with additional indicators or ignore the context of the market, such as supply and demand zones. In this video, I'll teach you how to overcome these challenges by combining the engulfing candlestick pattern with two powerful indicators to create a simple yet effective trading strategy. Step 1. Understanding supply and demand zones. Before we dive into the strategy, let's talk about supply and demand zones, which are crucial for identifying high-probability trade setups. Supply zones. Areas where the price is likely to reverse downward due to an excess of selling pressure. Demand zones. Areas where the price is likely to reverse upward due to strong buying interest. These zones help us determine key levels in the market where the engulfing candlestick pattern is most effective. Step 2. Setting up the indicators. To simplify the process of spotting these zones and patterns, we'll use two key indicators. Indicator 1, fluid trades. This indicator highlights supply and demand zones based on pivot points. It automatically marks recent highs and lows, saving you the time and effort of manually analyzing charts. How to set it up? Search for the Fluid Trades indicator on TradingView. Choose the version by a trusted TradingView guru. Adjust the settings. Swing high/low length, set to 50. Supply/demand box width, increase to 5. Match the indicator's colors to your chart for better visibility. For example, if your chart has a black background, set the outline color to black. Indicator 2. Engulfing Candlesticks by Ramunas. This indicator automatically identifies potential engulfing candlestick patterns, making it easier to spot trading opportunities. No additional settings required. Simply add it to your chart, and it will highlight bullish and bearish engulfing candles with green and red signals, respectively. Step 3. Trading rules. Now that we've set up the indicators, let's dive into the trading strategy. Bullish trade setup. Buy. Wait for price action to reach the demand zone. The demand zone, blue, indicates a potential reversal point where the price is likely to move upward. Look for a bullish engulfing candlestick. Once the price touches the demand zone, wait for a green signal from the engulfing candlestick indicator. Confirm and enter the trade. Wait for the next candlestick to close. If the green signal persists, place a buy order at the close of that candlestick. Set stop loss and take profit. Stop loss. Slightly below the demand zone to account for potential retests. Take profit. Use a 2-to-1 risk-reward ratio to maximize returns. Bearish trade setup. Sell. Wait for price action to reach the supply zone. The supply zone, red, signals a potential reversal point where the price is likely to move downward. Look for a bearish engulfing candlestick. Once the price touches the supply zone, Wait for a red signal from the engulfing candlestick indicator. Confirm and enter the trade. After the next candlestick closes and confirms the red signal, place a sell order. Set stop loss and take profit. Stop loss. Slightly above the supply zone. Take profit. Again, use a 2-to-1 risk-reward ratio. Real-world examples. Let's look at some examples to reinforce these rules. Bullish trade. Price touches the demand zone and a green signal appears. The next candle closes, confirming the trade. A buy order is placed and the trade hits the profit target successfully. Bearish trade. Price retests the supply zone and a red engulfing signal confirms the trade. A sell order is placed and the trade results in a profit. Avoiding invalid trades. In one instance, the price breaks the supply zone before conditions are met, invalidating the bearish signal. By sticking to the rules, this loss is avoided. Final tips for success. Always wait for confirmation signals before entering a trade. Stick to key levels like supply and demand zones for higher probability setups. Use a consistent risk-reward ratio to ensure long-term profitability.